Yeah, let's get started with today's session. So I'll start with a brief overview about what CFA is all about, and then we'll move into one of the topics that I've chosen for today's class. So what are the various subjects? As you can see, there are 10 subjects that we have in CFA. All the 10 subjects are same across all the 3 levels, which is ethics, quants, eco, then you have FSA, corporate issuers, equity, fixed income, derivatives, all-time and portfolio management. So these are the 10 subjects which is same across all the levels with different weightages in different level, right? So why is it that all the 10 subjects are tested on one single day? The main reason is all the subjects are interconnected. In say quants, you will learn how to calculate say standard deviation, but that standard deviation again you will use it in portfolio management. When you create a portfolio of any particular institutional investor or an individual, you invest in equity, fixed income and alternative investments, and these 3 kind of investments are different subjects altogether. We'll learn equity in detail, we'll learn fixed income in detail, so on and so forth, right? Ethics is something that is needed as part of your profession. Since you will be investment bankers tomorrow, it is your duty to make sure that you don't do any fraud, or you work for your clients' needs and not for your personal needs, right? So according to that, that's the reason all the subjects are interconnected, all the subjects are tested on one single day through one single exam for each level, right? What is the exam structure? So for all the 3 levels, you have 2 sessions, right? 2 sessions each for 2 hours and 15 minutes, right? 2 hours and 15 minutes for each session. And how many questions are asked in level 1? So level 1 you will have 90 questions in the morning session and 90 questions in the evening session. So that's how we call it. We call morning and evening session, but it happens in the morning, yeah, with a 30 minutes break in between. So that's how the exam structure is. So here in level 1 and level 2, the main thing here is not knowing the subject and getting the brief overview of what CFA is. Time management is very important. Time management is very important. The main reason for this is you are given only 90 seconds for each question. So considering 90 questions in the morning session, you have only 135 minutes. So you will have only 90 seconds for each question. So time management is very crucial in all the 3 levels, whether it is level 1, 2 or 3. And how the results are given. So at least now, starting this year, CFA Institute has come up with a way wherein they are giving you scores. For level 1, it will be out of 1900. You are supposed to score, any idea, anybody? You are supposed to score at least 1600. So this is the passing mark. So if you get anything below 1600, CFA Institute will give you a detailed report about which subject you performed well, because of which subject your scores dropped, right? And also I think all of you are aware that you are supposed to clear all the subjects. Even in one subject, if you fail, get less than 50%, then your exam is gone for a toss. So clearing all the subjects is mandatory, and crossing 1600 is mandatory for you to clear the exam, right? Coming with registration with the institute, generally before 7 months the registration starts for the exam. So you can register. If you register early bird, it will cost you 1000. It will cost you $1,140, which is early bird, and if you do a standard registration, it will be plus $350. So we will give you information about when the registration starts, about to end for May 2026. Early bird registration is about to end on October 15th. So if you are planning to write your exam in May, then you should register it now as early as possible. And once you register with the institute, it will give you all the details about they'll give you access to various study material that they have, various mock exams that they have, and all the details they'll provide you. And also another important thing that you should have to register with the institute for the exam is you need to have an international passport. That's mandatory. Without passport, maybe you can register for the exam, but you cannot write the exam. Passport is mandatory. So when to begin preparation? So this is the question I generally get asked from a lot of students who are full-time students and also who are generally working professionals. So because people who are working professionals are more inclined towards doing CFA, students are less. So now the frequency of students who are pursuing BCom have started taking up CFA, but for working professionals they generally ask me that how much time should I spend on a daily basis, or how many months do I need to prepare for the level and so that I clear the exam. So generally what I suggest is, if you are a full-time student, 5 to 6 months is good enough, so that if you are giving at least 5 to 6 hours a day, then 5 to 6 months is good enough. But if you are a working professional, then 8 to 9 months is required, considering you are giving 2 hours a day at least. You are studying 2 hours a day, and weekends you are giving as much time as possible. For working professionals, generally 8 to 9 months, you will be able to complete the syllabus, revise the syllabus, give your mock exams, do the revision and write your exam, right? And next, where to study from. This is where a lot of scam happens with students, wherein if they go online, they see that many institutes are coming up and saying, we have condensed the whole CFA syllabus in just 2 books. You need not go through the lengthy curriculum, you need not go through the lengthy Shweza books that we have. But never fall for that. I always suggest students to either refer curriculum or Shweza books. So if you register with us, we'll provide you with Shweza books. I use Shweza for all the 3 levels. Reading Shweza, doing questions from curriculum is good enough, more than enough for you to clear the exam. So don't buy anything that you find in the market which will tell you that just go through these books and clear the exam. Don't pray for that. Just Shweza and curriculum is good enough for you to clear the exam. Alright, finally looking at eligibility. Until 2024, the CFA exams eligibility was once you clear your graduation. So generally it was accessible to only working professionals. But starting this year, people who are pursuing their graduation, in the second year itself they can start their preparation. First year they can start their preparation, second year they can write level 1, and third year they can write level 2. So it is easier for people who are graduating now, who are in college now. They can get the degree very early in their career, unlike people like us who studied for who worked for n number of years and then took up CFA. Even I worked for almost 6 to 7 years, then I started my CFA journey. But eligibility now has changed, so people who are pursuing degree can take up CFA. About our lectures, as I mentioned to all my students, there is no shortcut to clear exam, and there is no shortcut for your preparation also. If you hear from your friend who is given CFA exam, say before you, and he tells you that okay, this topic was not tested, so don't study. Never do selective studies, no selective studies. Always go through the whole syllabus. Even a small LOS can cost you your exam, right? So go through the whole syllabus. Even here, when we are coaching our students, we don't miss even a single line, because it so happens that if your luck is bad, it will happen that the concept that you left thinking it is not so important, that will turn out in the exam. It might cost you your exam. So that's why no selective studies. Go through everything, revise everything for the exam, right? So that's about the details about CFA, what you are supposed to know before you get on to your CFA journey. Any questions until here, anybody? People online also, if you have any questions.
No.
Okay, super. So let's get started. So I have chosen FSA for today, which is Financial Statement Analysis. I'll give you a brief overview about what FSA is, what are the various financial statements that we'll study in FSA and more details around it. So when I say FSA, it is financial statement analysis. Come and sit in the class. Yes, please. You are? Ahmed, yes, please. So I just briefed them about the details of CFA. I just started with the actual topic for today. So we will be learning about FSA. When I say financial statement analysis, what's the first thing that comes to your mind? What are the various financial statements generally we look at if we are doing an analysis of a company? Balance sheet. P&L account, cash flow statements. And why do we analyze these companies? Why do we look at any company's financial reports, their annual reports? To know the progress, what is the company's profit, what is the financial standing of the company, what are the future projects that the company is planning to, what is the message from the board of directors, so on and so forth, right? So that's why financial statement analysis, you as analyst, it's very important for you to know the financial standing, because tomorrow when you become a financial advisor, say, and if you want to recommend to your clients which company to invest in, so by looking at company's fundamentals, you can decide whether that company is a good investment or a bad investment. And where do you get the company's fundamentals from? From the company's annual report, right? So that's why the role of financial statement analysis is, if you yourself want to invest, you will look into company's financial reports. You look into their income statement, balance sheet, cash flow statements, their footnotes also. Whether you want to invest or if you want to suggest your clients to invest. So that's why financial statement analysis is important. If you are a bank, do you want to extend credit to them? Do you want to check what is the company's credit worthiness? What is their credit rating in the bank? If the companies have issued any bonds, what is the credit rating of those bonds? So do we understand what are credit ratings? So companies are usually rated, and there are various credit ratings that the company is given, and also their bonds are given AAA, AA, A, and then it goes on BBB and B. Yeah. So for all these things, how will a credit analyst will know what is the credit worthiness of the company? By looking at their financial reports. So it is not only useful to analysts like you and I, there are various stakeholders who look for companies' financials, like their creditors, their employees, their clients also wants to look at if the company is good enough or no. Do we want to transact with their company or no? Their suppliers also. Will we be able to sustain, will they be able to pay us for whatever we are supplying to them? Do they have enough cash available to make the payments that they are obligated to make us? So all these details we will get from company's financial statement. Next, analysts also look at the past performance of the company, look at the previous annual reports to see what is the future prospect of the company, how the company's future cash flows would look like. So past performance to predict or estimate future performance of a company, right? And finally, to identify risk. Do the company have any risks that it might face or it is already facing? Does the company have any operating kind of risk, or does the company have any, if the company is into import and export, do they have exposure to any currency risk? So what are the various risks that the company is exposed to? Even those details you will get from the company's annual reports, their financial reports, right? So when I say we look at companies' financial reports, all these people look at companies' financial reports, there should be a way in which company will prepare their financial reports, right? There are 3 different companies. Everybody prepare their financial reports according to their whims and fancies. There is a possibility that they are hiding something. They are not recording everything, or there is a possibility that I as an analyst cannot compare these 2 companies. So if I am an investor, I want to invest into banking industry. And if each bank is publishing their reports according to their internal method, I cannot compare 2 banks and decide which bank can I invest in. So that's where the standard setting bodies come in place, wherein they tell you what is the process in which you are supposed to record your accounts. You are supposed to record your revenue or say your long-lived assets. What is the process in which you can record it? So these are standards that you are supposed to follow. If not, you will be fined or there will be some scrutiny and things like that. So that's why every company not only have their internal auditors, they hire external auditors to make sure that their accounts are in place. There is nothing which is hidden.
We lost your voice.
Can you hear me now? Not changed anything.
Yeah. You are audible now.
Yeah, am I audible now? Super. Alright,
Yeah,
just
yeah.
let me know if you lose me again. So that's where standard setting bodies come in place. So there are two standard setting bodies that we have across. One is FASB and IASB, Financial Accounting Standard Board, and IASB is International Accounting Standard Board. So Financial Accounting Standard Board sets the rules or standards for anybody for US GAAP, and IASB sets the rules for IFRS. IFRS, International Financial Reporting Standards. US GAAP is Generally Accepted Accounting Principles. It's okay. Yeah. So US GAAP is used in US as obvious, and IFRS is used across. Even in India, most of the companies, they are supposed to follow IFRS. So except for US, the rest of the world uses IFRS. So here in FSA, we will learn what are the things which are similar between both, under both US GAAP and IFRS, and what are the things which are different. So when you are say analyzing two different companies, one is using US GAAP, one is using IFRS, you know what are the things to watch out for, which might be different in both the companies, which you can either change one of the companies to come in line with IFRS or change another companies to come in line with US GAAP, and then you can do a proper apple to apple comparison. So that's why, so all these details about company following either US GAAP or IFRS will be available in company's footnotes. So apart from your income statement, balance sheet, cash flow statements, footnotes are also very important for you to review when you are looking at any company's financial statements. Why? Anybody? Why footnotes are as important as looking at the financial statements? Because footnotes generally give detailed information about what they have recorded in income statement or balance sheet. If they have recorded say revenue, and if the company has their branches across 5 different countries, which of the branch is giving more revenue? So geography wise you can get details about the company, and if the company is into multiple lines of business, and if they have recorded revenue, you can see which line of business is doing well. So all those details will be recorded in the footnotes. So footnotes are equally important as looking at the financial statements. Next, when these standard setting bodies come up with some standards, there should be somebody who makes sure that company is following them. So this standard setting body's role is to make sure that they come up with proper standards which companies should follow. But who will make sure that companies are following these standards? So that is where the regulatory bodies come in place. So who is the regulatory body in India? SEBI. SEBI. And in US we have something called SEC, which is Securities Exchange Commission. So generally whatever we learn across CFA is based on SEC. Considering it's a US based course, so whatever SEC's rules are there, we'll learn that. And what is the role that they play as being the regulatory body to make sure that every company is following the standard that they have recorded that they will follow, whether it is US GAAP or IFRS. Right? Clear? So this was a brief about financial statement analysis. Just give me a second. Yeah. Moving forward, let's look at what are the major financial statements that we generally look at. income statement, balance sheet, cash flow, and statement of changes in equity. So when I say income statement, what are the major things that it records? Records profit. So how do you get profit? Which is nothing but your revenue minus your expenses will give you your profit. So what are the various expenses that we have? Revenue is nothing but is also called as your top line. The various expenses can be your COGS, which is your miscellaneous expenses, your salary expenses, your depreciation expenses, your taxes that you pay, the SG&A that you pay. I can put an outline of, say, income statement just for you to know. Revenue is also called as sales, right? Minus your cost of goods sold will give you what? This is your 12th standard revision. This will give you your what profit? Net profit. Gross profit. Will give you your gross profit, right? And how do you calculate your gross profit margin? Gross profit margin is your gross profit. Your gross profit divided by your revenue will give you your gross profit margin. When I say gross profit margin, the revenue, say it's 100 and your cost of goods sold is 80. Your gross profit margin is 20%. Your profit is 20, so your gross profit margin is 20%. Right? Next, what are the expenses you have? Say you have SG&A, sales and other general expenses, your admin expenses. Then what will you get? What will you get after this? You will get EBITDA, earnings before interest, tax and depreciation. After this, what do you have? Depreciation. You will have depreciation. Then you will record something called as EBIT, which is earnings before interest and tax, not income, or it is also called as your operating profit. Right? Next, you will deduct your interest. So what is this interest? Whom are you paying this interest?
Creditor. Borrowed money.
Any money that you borrowed from bank or anything, you pay interest on that. Or if you raised debt, if you have raised bonds, you pay interest on that, right? And then you also pay taxes, and this will give you your PAT, which is profit after tax. So this revenue is called as your top line. Your net profit or PAT is called as your bottom line. These are your corporate jargons, but you should know what is top line, what is bottom line. In board meetings, they will not use the word revenue or sales or net profit. They will use the word top line and bottom line. So this is how your income statement looks like. But in FSA, we will learn in detail how can we or when can we record a revenue. Do we wait for us to receive cash once we have made the sales, or once we have just transferred the good from the seller to the buyer, do we record the revenue? In terms of depreciation, what are the various assets which gets depreciated, right? And if we have any kind of intangible assets, they also get depreciated. Then we will look at how interest is calculated, and tax also. There is a whole chapter on taxes. So we will learn all these things in detail. This is just an outline of how your income statement looks like, but there is a lot of calculation that goes in detail in each of these line items. It's not as easy as it looks here, but so whatever are the details we will learn here, and those details, when you read any company's annual report, you find in their footnotes. On what basis have they recorded revenue? When I say depreciation, which method of depreciation have they used? Have they used accelerated depreciation, or have they used single line depreciation? What is the useful life of the asset that they've considered? what is the salvage value that they have considered, right? So all these things we'll learn in detail when we are doing income statement. There's a whole chapter on income statement, and within the income statement there's a whole chapter on inventory. We have taxes as a different chapter, right? Let's move on, and now let's look at balance sheet. So for balance sheet, what is the formula that we have for balance sheet? So
Ma'am,
yes.
can you do one thing? On your Mac, can you minimize the preview so that your screen will be visible to us?
Okay. Can you see now?
No.
Okay.
So, if you will stop sharing. Oh, okay, stop sharing.
That's what I did. Now it's way better, right?
Yes. Yes.
Yeah. Let me see if I can pin this. Wait a minute. Not able to pin this view.
But no, that is possible at our end. No, it is not possible at our end also.
It's not possible. Okay, I'll have this checked for next time. But this way it's easier for you to view it, right?
Yes.
Okay, super. Okay, now let's look at balance sheet. So the high level equation of a balance sheet is assets minus liability will give you what? Assets minus liability will give you your equity. Or assets is equal to liability plus equity, however you want to arrange it. So now let's look at what are the various things that we see in a balance sheet on a high level. So we have assets here. So I'm using Indian method, and liability here. I'll just erase this. So yeah, assets and liabilities. So under assets, what are the two major kind of assets that we have? Current asset and non-current asset. So I'll write non-current asset here, and then I'll write current asset here. Under liabilities we have current liability, non-current liability, and we also have something called as equity. We have non-current liability, and then we have current liability, right? So under non-current asset, which is your fixed assets, your long-lived assets, so these are the assets which is supposed to give you benefits for a long period of time. That's why you record them as asset on your balance sheet rather than an expense in your income statement, right? So that's why we record them here, right? So what are the two major kind of assets that we have? Long-lived assets. So we have something called as tangible assets, like your property, plant and machinery, your furnitures, your fixtures, all these come under tangible assets. And then you have something called intangible asset. Examples of intangible assets?
Trust.
Okay, trust,
Services.
which is part of your goodwill. Then you'll have services, not a asset per se, but that comes as part and parcel of your business. But you have something called trademarks, you have copyrights, you have royalties, you have patents. All these will come as part of your intangible assets. So that's why in intangible also we have bifurcation. There is something called as assets which have finite lives, which live for a number of years. If you have taken a trademark, you've taken it for a couple of years. For patent will also last for a couple of years. And you have something called infinite lives. And this is where your goodwill will come. So there is no what do you say, life for a goodwill. You cannot say this goodwill will live for 10 years or 20 years. So that's why it is considered as infinite lives. So again, tangible assets, intangible assets, we'll do this in detail. We have one whole chapter on long-lived assets wherein we'll discuss these two separately and in detail. So for tangible assets, how do we record them in income statement? Through depreciation, right? If we have bought an asset for say 20,000 and it has a life of 5 years, we will record every year depreciation of 4,000, right? We will record 20,000 in asset on the asset side minus depreciation 4,000 in the first year, and that depreciation will record in the income statement also. So basically whatever the cost that you paid for that asset, you are spreading across multiple years. That's how you record it. So for tangible assets we record depreciation, and for intangible assets we record something called as amortization. If you've heard this word for the first time, don't worry, it is similar to depreciation and we'll do this in detail when we start with FSA, right? Next, coming to your current assets. What are the major current assets that we have on our balance sheet? Current asset is generally which has a life of 1 year or less than a year. Generally current assets are used for your day-to-day business, right? So you have your cash or your bank balance, then you have, if you have any marketable securities which you can sell in need of cash, then also you have something called as accounts receivables. What is accounts receivables? Ever heard of this? What is accounts receivables? Sorry? Okay. Whenever you make a sales on credit, you will record a revenue on the income statement, but also you will record something on your balance sheet called accounts receivable, the money that your clients owe it to you. The money that you are supposed to receive from your clients is called accounts receivables. Then you also record your inventory. Inventory that is lying with you which you have still not sold is called as inventory. Even this can be converted into cash once you make the sales, right? Now coming to, we'll leave equity. Now let's come to non-current liabilities. So here, if you have taken any long-term loans, we'll come here. If you've taken any long-term loans for more than a year, say 3 years, 5 years, 10 years for your business, those will come here. And if you have issued any bonds. Ever heard of the word corporate bond? Many big companies issue their bonds wherein investors like you and I can buy those bonds, and they will give us interest on a regular basis called coupons, and as and when they pay out these bonds, it will get reduced from the liabilities and we will get our payments. Next, coming to current assets, current liabilities, sorry. So these are the obligations which you are supposed to pay to your clients, like your accounts payables, or if you have any unearned revenue that you've recorded. We'll talk about unearned revenue in today's class. Unearned revenue if you have recorded it. Okay, so this is the outline of how your balance sheet looks like. So the main goal in your 12th standard was to make sure that your balance sheet matches. Yeah, your assets are equal to your liabilities. Now coming to equity. What does equity have on a high level? Preference shares. Your equity shares that the company has issued. Then it will also have your retained earnings, whatever profit that you make in your income statement after paying dividends, whatever you retain with the company, reinvest in your company will come in your equity. If the company has repurchased any shares that they've already issued, even those will get recorded in equity. Right? Right? If the company has issued say 10,000, 20,000 shares and they've repurchased some for some XYZ reasons, those will also get recorded under equity. Any doubts till here? Anybody?
Well, that concept I don't understand, like asset minus liability equity.
So on a high level, this is asset, this is liability. So this portion is your liabilities.
Okay.
Right? This whole portion is your assets. So asset minus the liability, if you do, you will get this portion, which is equity. right? You are from non-commerce background?
Yeah.
Don't worry, we'll do it in detail, all these things. So since I'm looking at the whole crowd, I've designed it this way, but we'll learn all these in details. I'll do some prerequisites that students are supposed to know, so you will learn this in detail. Yeah, here I'll erase this. Next, coming to cash flow statements, even that we'll look at on a high level. So what does cash flow statement mean? Inflow and outflow of cash, as the name suggests. So there are three different kinds of cash flow statements that we have. Cash flow from operating activity, cash flow from financing activity, and cash flow from investing activity. So we will do this statement, whatever is the figure will go into your balance sheet as cash. So just to record that one line on your balance sheet as cash, you need to prepare a whole statement of cash flow. And there are 2 chapters just on cash flow statements. So you know how vast it is and also how important it is. Say if there is a company that is making good profits. If you see their balance sheet, you see profits. But whatever sales they are doing everything on credit. So generally there is no inflow of cash that is happening. They are making good sales, but everything is done on credit. So is the company's financial stability sound? No, because there is no cash. There is no cash that is available for them for their day-to-day business, for their working capital. So that's why looking at income statement, if you see the company is profitable maybe, but when you look at the cash flow statement, will you know that whether the company is doing well, will they be able to sustain in the long term, will the company will be able to meet their short-term obligations or no, right? So cash flow from operation is your day-to-day operations, the cash that you have. So what are the various things that is recorded in cash flow from operating activities? So the inflow in cash flow from operating activity is generally the sales if you've done it on cash. If you've made any sales on cash, then that will come as a cash inflow under your cash flow from operating activities as sales, or you had any accounts receivables and they have paid it to you, then that also will come as an inflow under cash flow from operating activities. What are the various outflows that you have? So when I say operating activities, it is your day-to-day business. What are the various cash inflows and outflows that keeps happening on a daily basis? So what are the various cash outflows that you have? What are the various cash outflows that you have? You pay salaries, right? Other expenses, you pay taxes, and if there were any accounts payable that you were supposed to pay. So accounts payable, just for your information, so accounts payable is nothing but if you bought certain goods from your supplier on credit. You not paid it to them, but you bought it on credit and you tell them that I'll pay you after 60 days, 90 days, whatever is your terms. And if that payment you've done in that particular year, that will record as cash outflow. So balancing figure will come under cash flow from operating activities. So there are 2 methods in this we can calculate this. One is direct method, one is indirect method. We'll do that in detail when we do cash flow statements. Right? Now let's look at what is cash flow from financing activities. When I say cash flow from financing activities, where are your finances coming from? Have you raised equity or have you raised debt? If you have repurchased equity, that also will come under cash flow from financing activities. So generally it is your liability side of balance sheet from where you can find your cash flow from financing activities. Cash flow from investing activities is if you bought any asset, that you will record under cash flow from investing activities. If you have sold any asset, what is the money that you got out of that? So all these will come from cash flow from investing activities. This is generally your long-lived assets. If you have purchased any, if you have sold any in a calendar year or a financial year, Those you will record under cash flow for investing activities. This is the actual cash that you're paying when you're buying an asset, right? And the cash that you receive if you sell an asset. So cash flow statements is generally the exchange of cash that happens. Only if exchange of cash happens will we record a cash flow entry. Otherwise no. If you have made sales on credit, we will not record cash flow entry. If you have purchased anything on credit, we will not enter into a cash flow statement. Those we will record separately and we will teach you how to record those entries. Right? So this is an outline about how your cash flow statements look like. Why is it important and what are the various entries that goes into each line item under your cash flow statements. Clear? And next, statement of changes in equity, as I mentioned, it records your common shares, your preference shares, your treasury shares, your retained earnings and all those things. Again, these things, if you don't understand what is the preference share, what is the common share, we will do that in equity chapter, and here also I will briefly introduce what does each mean when we start with the subject. Clear till here? We'll move forward. Now we'll look into income statement in detail. We have more 20 minutes. Okay, when we say income statement, any company that has been formed, there are two various basic assumptions that goes into when the company is formed. One is going concern. If I open a company today, I will not say that I have opened this company for next 10 years. My motto will be the company should run to eternity. I don't want to close down this company in the near future. That's what going concern means, and that assumption is there for all the kinds of companies across. And next assumption is called accrual accounting. So accrual accounting basically means when you make sales, whether you make that sales on cash or credit, you will record a revenue against that. The only reason for you to record that revenue is the product has changed hands. The ownership has been transferred from the seller to a buyer. If you have received cash against that is not important. The ownership has been transferred, that is important. That's what accrual accounting means. And this is also across all the kinds of business across the globe. They use accrual accountings. Nobody used cash accounting wherein if I made the sales, only if I receive the cash will I record a revenue. That's not the case. Once the ownership has been transferred from me to my buyer, we will record a revenue. Right? And when we record a revenue, if the sales is made on credit, I will record a revenue. But have I received cash? If I make the sales on credit, have I received cash against that? No. But I should record something on my balance sheet also to make sure that what is the outstanding money that my clients are supposed to pay me. The money that I am supposed to receive. So whenever you make sales on credit, there are two entries that are passed. One is on your income statement, you will record revenue. If you made sales worth say 10,000 with the client, you will record your revenue as 10,000. At the same time, you will record an entry in your balance sheet also. Because you have not received this money, there is some money that you are supposed to receive from your client. You will record something on your balance sheet also. What is that entry?
Outstanding income.
Sorry?
Outstanding income.
Another accounting name word for it. Okay, in the balance sheet, where will you record this? Asset or liability?
Liability.
So liability is something you are supposed to pay or something that you are supposed to receive?
Pay.
Then, so is this something that you are supposed to pay? No, right? This is something that you are supposed to receive. So it's an asset. Right? Something that you are supposed to receive is an asset. So under asset, where will you record this? Under current assets, right? Because you are supposed to receive this in next 30 days, 60 days, whatever is the credit cycle. So you will record under current asset. Under current assets, we will record something called as accounts receivables. The same 10,000 we will record in the balance sheet as accounts receivables, 10,000. Is this clear? When we make sales on credit, what are the entries that are passed in income statement and balance sheet? And as you receive money for that, you will not touch your income statement. As you receive money, you will reduce your accounts receivables, and what is the other entry that you will pass?
Accounts payable.
What is the other entry that you will pass? You are receiving cash. So you will record an entry in your cash flow statement under cash flow from operating activity. Clear? I know it's too much for one day, but these things you should understand if you are a financial analyst. And this is just basic. Basic ka bhi basic hai ye. You can understand that. Okay, so this is what happens when you make sales on credit. Okay, there is another way where you pay advance money when you buy something. Like if you take some subscription, if you are taking a subscription for Netflix, either you can pay them monthly if you want that, or generally we take yearly subscription, right? So Netflix, will they record everything as revenue once they receive all the money, or how do they manage such entries? How do companies who receive advance money record their revenue? So what they generally do is they record something as unearned revenue, unearned income on their balance sheet as non-current liability. Because this is something that they owe it to their clients. Though they have received advance money, they have still not given them the services that they promised. Right? So they will record something called as unearned income. So how much do you pay for your Netflix yearly? I don't know, I don't have a subscription. 1.5k? 2k? How much? Let's take an example of 2k. Right? That you pay. So Netflix, the moment you pay to them, they will record an unearned income on their balance sheet. Since they have still not given you services, you have paid them in advance. Right? So what they do is generally every month, as and when the month passes, they will record the revenue, because that is actually the revenue that they have earned. So every month they will record the revenue, and they will reduce this amount. By the year end, this will be 0 and this will be 2000. They will not record everything as 2000 on the day one when you actually make them the payment. So we are learning about two different kinds of sales that companies do. Either they do it on credit or they do it on cash, that is regular. There is no changes or no XYZ entries that you want on cash. Cash sales you have made, you directly record the revenue. No too many entries, but when you do it on credit, you will have to record a lot of entries. And if you have something called a subscription plan, even then you will have to record a liability, and then monthly you should record the revenue as and when you provide services to your client. Clear? Okay, moving on. Last portion for today's class. So under IFRS and US GAAP, when do we say that the sales has been made? When I say I am recording a revenue, what are the activities that are supposed to happen? That so if you walk into a store, you give them money, take the product, sales is completed. But there are various different kinds of sales that happens. If you've given a project to somebody to construct a house for you, to construct a warehouse for you. So for them to record the sales and for you to record that as an expense, there is a long period that will go on. 1 year, 2 years, whatever is the project for how many ever years. So it's not easy that you record revenue once you receive the money. You record sales once you receive the money. It goes through a lot of process. So now we will decide when do we say that the revenue has been earned. How do we recognize revenue? First one is You will come with a contract with the person. I give you a contract to construct a house for me, so we will decide what is the contract between us. So we will decide that you will finish the contract in 2 years. What is the cost that I will pay you, and what is the expense that you will incur, and what is the profit that you will make as a contractor. So that is the contract between two parties. What is the performance obligation? So in this case, what is the performance obligation? The contractor is supposed to construct your house. That's your performance obligation. So there can be either one obligation or there can be multiple obligation, that he should construct one floor. That was one of the obligations. So once first floor is constructed, you'll make him some payment. Once the second floor is done, you'll make him some payment. So there are different performance obligations that the client, that the person who's taken the contract will have. And next, what is the transaction price? How much price is for that particular performance obligation? If for the contractor the cost is say 8 million, he will charge you 10 million, and 2 million he will keep it as profit. So what is the transaction price that they have arrived for that performance obligation? That we will define. And next we will allocate, if there are say 1, 2, 3 performance obligations. Say first they will construct the house, then they'll give you services like maintenance services of the house. There are 2 performance obligations. So each will have a different price. For the construction the price will be different, for the maintenance the price will be different. So in the fourth step you will have to allocate for each step or each performance obligation what is the price. And next, finally, you will recognize the revenue. Once all these obligations are done, once you've defined what is the performance obligation, what is the transaction price for this, and once the exchange of hands happen, you give the product and you receive the cash against that. So this is how you will recognize revenue. We don't have time, it's already 3. So we will learn what are the different kinds of businesses that run and how do they record their revenue. If you are into construction business, you will record your revenue across multiple years as and when you complete the project. If you are in a franchisee business, how will you record your business? If you are acting as an agent, how do you record your revenue? If you are into service industry providing softwares to your clients, how do you record your revenue? So we will learn how different industries or different lines of business record their revenue, and how do they recognize all these things in their income statement, and how do they record their expenses also. So all this in detail we will learn in income statement chapter. Right? With this we come to the end of today's demo. Ready to take any questions if anybody has.
Yeah, I have one couple of questions.
Yes.
Now the thing is,
Yeah.
now there are 10 odd subjects in for level 1.
Yes.
So what will be our approach? It will be subject by subject, or we will go with multiple subjects parallelly?
No. We'll go subject by subject. Multiple subject parallelly will confuse the students. So we'll do subject by subject. Yes.
And second part, how are we going to have grasp on calculator?
So I will take one session on just for you to learn how to operate a calculator, and then as you practice, as you do multiple questions, you will get a hangover how to use the calculator. So in one day nobody will ace at how to use the calculator. That's why they say for you to clear CFA, for you to ace at the exam, you should be quick at calculation. So that will come through practice.
Okay.
Yeah.
And the order of subjects will be based on their weightages or their complexity, or
so that you leave it to me. I will design which subject will start first and in which order we'll go. But yes, depending on their weightages, we will study. But it doesn't mean that any subject that has less weightage will keep it at the end. Because as I initially mentioned, you're supposed to clear all the subjects. And the lesser the weightage the subject has, the more as in the less you can make mistakes in that. So say derivatives has the least weightage and it has say 8% or say 5%. They will ask you only say 9 questions. And for you to
Mm-hmm.
pass in derivatives, you should get 7 correct at least. So we
Mm-hmm.
cannot say that since derivative has the least weightage, we'll keep it at the end. In fact,
Mm-hmm.
the subjects which has the least weightage, you should be more clear with that subject, because the room for you to make error is very less. Getting
Mm-hmm.
my point? If ethics has say
Right.
20%, they will ask you say 30 questions for an example, and for you to clear, you should get say 21 or 22 correct, right? So there is room for you to get 8 incorrect answers. So in that way, we will not pay more attention to what is the weightage. Our main aim will be to clear all the subjects, because as the weightage decreases, the room for error will also decrease.
Right.
Yeah.
Okay. Thank you. You answered my question.
All right. Anybody else? Any questions? Okay, then we'll end the class. Thank you so much for joining in, and I hope to see you all in my class very soon. All the very best.
Excuse me.
Thank you. Thank you so much.
Bye bye.
Excuse me.
Yes? Yes, Jobis?
Hi, my name is Jobis. I just have a question.
Yes?
Like, I'm worried about how much of quantitative questions are there. Like, what is the weightage? Like, I'm a little weak on that.
When you say
So
quantitative, you mean
I've
numericals?
just gone through this, and
When you say quantitative, do you mean numericals?
yeah.
Okay, so don't worry, there is nothing like math that we have in CFA, but definitely you will have numericals, and that is my headache. I will make sure all my students understand how to do numericals. We will not get into the mode of you memorizing the formula and then doing the numerical. So we will learn concept wise. So certain concepts which are numericals also, you might get theory based questions. So generally in CFA there is, in level 1 at least, it is like 50-50, that you will get 50% of questions as numerical and 50% of 50% of questions as theory. So don't worry if you are not good at maths, it has nothing to do with CFA. Though you have numericals, those are subject as in understanding based numericals, and not formula based where you need to memorize the formula and
Because I
discuss.
saw the syllabus, and there is a lot of statistics and everything discussing in
Yes,
this, right?
statistics is only there in quants and a bit of it in portfolio management.
Yeah, portfolio management, some formulas and everything.
Yes.
So
So if we understand
that's
the
where the
concept,
problem is. Like,
if we understand the concept, you will be able to crack those questions. And again, as I mentioned, the more you practice, the more the easier will it be for you to crack those questions on the exam. So practice is the key for you to clear
okay.
CFA. And for that, we will make sure that we give you enough tests on a regular basis, say weekly, fortnightly, so that you practice whatever is been taught in the class. It's not like I teach you, take it, and then we leave it there. We will be practicing those on a regular basis, and also we will have separate doubt solving session. Just in case you didn't understand anything in the class, we can have a different session for that altogether. Yeah?
Okay. So what is the timings of the classes?
Jobis, can we discuss this offline? I will get in touch with you, or Neil will get in touch with you. Is that okay?
Yeah.
Yeah, we'll get you the details about the timings and everything else. Alright, so we will end the meeting for now. Okay, people offline, any questions? Sayed, Ahmad?